There is a substantial risk of loss associated with trading forex, binary options, stocks, or equities, collectively, asset classes. Only risk capital should be used for trading. Trading in any asset classes is not appropriate for everyone. Past performance is not necessarily indicative of future results. No representation is being made that investors will make profits or will not sustain losses. Before trading in any asset classes, investors should consult with their professional broker, financial advisor, or financial consultant to determine whether trading asset classes is appropriate. Investors who trade in any asset classes should only do so if the capital used for this purpose represents funds that an investor can afford to lose without adversely impacting the investor's lifestyle. No trading strategy or methodology is without risk of loss. No trading strategy is risk-free, and no trading strategy can guarantee profits or freedom from losses. Investors risk losing the cost to execute any transaction, including associated commissions or fees. You should carefully consider whether trading in any asset class is appropriate for you in light of your investment experience and financial resources. Any trading decisions you make are solely your responsibility and at your own risk. None of the statements or materials in the Auvoria Prime chat rooms constitute a solicitation or recommendation to buy or sell.
Welcome to the Tuesday session. Today's the 16th. Let's just call this the fast rip-through Tuesday session. It's going to sound a lot like Saturday session. Nothing's really changed as we move into the holiday season. But my name is Steve Vetterl. I am the firm's CMA. My goal is to try and find the nuggets for you each week and keep you away from the landmines. How about that for our geophysical analogy? Let's go back into the Forex calendar just real quickly. The Prime community is getting more active. I like it. So you can always put out requests to friend people and follow along on a news feed. I'm getting news feeds for everything because I've subscribed to all the software, but it's getting quite active. So it's actually cool to see. Changes from software developers. There's obviously when you go into the live, some of you may have already seen. My market watch is an example. You can scroll down and see the whole schedule when we're presenting as a company in terms of sales or any of the call updates from Chris, Bill, and the team to each of the developers. So it's actually pretty cool. Plus, you can get all of the recordings, both midweek and then the Saturday calls that yours truly tries to put on. So with that being said, let's move into the calendars I talked about on Saturday. Yesterday, we had some things going on. Most of what's taken front and center stage has been the infrastructure bill that was signed by the idiots in DC, of which the transportation secretary has a ridiculous amount of power over how much of these funds are divvied up. So hopefully these funds will be given to figuring out the log jam at the U.S. ports, primarily in Los Angeles. That would be in good money spent to fix what I have learned to be a total mess, which is going to affect all of us as Americans this holiday season in one form or the other, right? As an example of me, selfishly, with some of the specialty drinks I drink, you just can't find them at Walmart anymore. The shelves are empty, so I have to order the specialty drinks on Walmart's website. And in the case of the last order, it took a freaking week to get here. So, it's almost like you got to order early. It's crazy. So, today, retail sales, you may be seeing here on the screen. So the forecast came in high, no surprise, right? All of these forecasts have been coming in hot, whether it be this country, European countries, the vast majority of developed countries that I track. These numbers have been coming in hot. I think the thing that was kind of surprising here was the retail sales, and maybe that's just a pickup. Possibly. I would imagine there's some core component in there of people that are just afraid they're not going to get their stuff for the holiday season, so they're just out buying right now. Could be wrong, probably right. But that's going on with the calendar. The calendar is going to be light coming up for the next few weeks. No surprise, it's holiday season. It's the time to grab all the family members and throw lots of crazy parties and have all kinds of crazy political discussions come up and piss some people off at parties. So it's all part of the fun of the holidays, right? So, but as I always joke, holiday parties are what they make of them. So you can either relish in your misery, or you could be like myself and try and talk to everybody and put out lots of hugs and lots of shots. So that being said, I get asked a lot about my social media. I try not to. I don't do anything on Facebook, but here is my Twitter. I have a LinkedIn as well. Why did that not show up? Yeah, let's post that again. So you just follow me at FXES Trader. Just put that tagline in here. I do a lot of retweeting of just really good stuff. I don't really post a lot of original content. Although I thought this corporate tax earning is definitely something everybody wants to be in on. Do keep in mind, we deal with a lot of clients that come to us with really highly appreciated stock. And as the older generation is passing on, this is much more in focus because of the movement, obviously, of equity markets over the last couple decades. We had a client that just came to us with about 2.6 and highly appreciated about 4 or 5 different stocks. This is a Pennsylvania resident. Her father, God rest his soul, just passed, and she got to step up in cost basis, right? But if she continues on that path, and taxation continues in terms of capital gains at its current rates, which we very much do not think that's going to be the case, she's going to have some significant tax problems down the road. So the risk management in this discussion is that if you genuinely think taxation, at least in this country, from either regular income or capital gains, is going to be higher down the road, and most people will agree with that statement just very simply because of the trillions and trillions of dollars that we have printed in debt as a country, then it may be wiser to find ways to move assets into a tax-free position. Okay. There are ways to do that. It can be fairly complicated, not necessarily that costly, but there are very efficient ways to do that, that even if they do come clawing at assets moved into these positions in future legislation, it'll be grandfathered in. So that's the discussion we're having with a lot of clients right now. Let's move on to the charts. I'm going to go through these real quick. For anybody trading equities, we had a pullback in the S&P. Now we're pushing up against towards highs. These are just daily charts I'm going to rip through. Q, same thing. It's kind of the same thing took place. The Dow hasn't quite gotten near that high that it was at. Bonds, notice we're moving towards the lower end of the spectrum. So remember, as price of the bond falls, the yield rises. Talked a lot about in newsletter we're building in on Saturday of a lot of confusion in the marketplace, even among some of the biggest pros, as to why rates keep moving lower while inflation is heating up, right? So it's sort of an interesting dichotomy I talked about on Saturday. If you want to see the recording, you know how to get there. Now, on to the dollar. This is by no means, with especially a couple of comments I got via DM last week from a bunch of our subscribers. This wasn't any great prophecy on anybody's part, especially myself. I've been squawking about this for 4 months now, that at some point we're going to rip up into this area and test out what truly is going on. This is the best way to view this on a weekly chart. And I was very adamant that if we did move into this area, there's no way I'd be fighting this freight train, right? And that we were probably going to completely cross this, what I call notch area, or low volume nodes, is all kinds of terms used for these air pockets or zipper based areas I talk about, but that we were going to rip across the whole spectrum. We did it in 2 days. So and for some of the comments that people are posting, look, we're all confused. So I saw an interview the other day with, I think it was, one of Julian Robertson's little tigers. I forget what the hell he's. Anytime you hear Julian Robertson's Cubs. It's basically a whole bunch of hedge fund managers he spun off that are now running many funds that are in the billions. I think it was, I forget what his name was. There's like 7 or 8 of his Cubs that have spun off into different funds, but one of them was talking about like his whole credit desk is like totally confused. So they're sitting in huge chunks of cash right now just because they don't want to be in equities, obviously, and they're not. They they just don't really have a good feel for what's going on, and it's crazy to see even some of the best pros out there, confused. But I'll tell you, at least if you go through, if you want some clarity, I can't say you're going to get any from doing this, but if you want some clarity, you can go through my Twitter feed, see what Jeffrey Gunlock. He's one of the smarter guys in this country. He's not a Cub, but he runs a credit fund in LA called Double Line Capital. He's a very well respected guy. He's a good conservative. And he really just sort of shakes out all the craziness going on in politics and from both sides, and sort of cuts through the crap of how it's affecting interest rates, money supply flow, and the credit markets, which is essentially bonds. So they deal in a lot of global portfolios as well. So they do a lot in European country bonds and so forth. So it's always good insight to get, far smarter than I ever have time to be. So I choose to just read some of his comments, and he typically echoes the sentiment of much of the at least 10 or 15 really smart money guys I follow that are all billionaires that are incredibly insightful when they don't have to be, with their comments on Twitter. And I know you'll hear a lot of the haters say things like, oh, well, they're just talking up their book. And, not really. When you come on and just cut through what's going on as far as policy decisions related to money supply, you're not talking your book. You're just trying to give people some insight into what's going on. The more insight and the more education we have, just think about all the, hours and hours of me droning on in Saturdays about this stuff. I've had at least a couple dozen people come to me and say, hey, Steve, we've taken tons of nuggets out of your speeches or what are your talks on the weekends or, any of the stuff I've done publicly. And, that's really my goal, I may go on and on about subjects, but the key is to just take some nuggets out of it, get a little more dialed into just macro what's going on as far as money supply, this country, et cetera, central banks, stuff like that. It all helps in the end of risk management, all dialed down to a single trade and what type of risks you can take relative to the current climate. All right, so I guess the big question probably should be asked, hey, Steve, what happens next? I have no idea. What more than likely will happen is that we're going to spend some time building a sideways trade. So if you can just envision going forward, I think, let's break this out a little, get a better feel. I think, could be wrong, right? We've came up against this area. This is just a weekly chart. 1, 2, arguably everyone's these top 4 tips. So what was that 6 times, 7 up against this area in terms of weekly touches of it. And eventually you have a light pullback and then a blast through, right? This is a typical quality chart pattern. Some would call this an inverted head and shoulders. I don't really have a pattern labeling for this. Looks kind of sloppy in a weekly pattern. But the bottom line is that we were building higher highs and lower, higher highs and higher lows. And then eventually you'll break out. And if you have a pocket, as we do, even though it looks like there was some trading through here, it's lighter volume, you had just a zipper move through an area, more than likely you're going to go test that area real quick. Look at that. We almost tested it to the tick. See that? It's because with all these areas, and I guarantee there's a lot of institutions out there that were caught on the wrong side of this trade. So what do they got to do? They got to buy back to cover. What does that do? It creates buying pressure. It pushes markets up or down to a particular area. They usually cross right over to the other zone. I'd much rather be riding this right up, or in the case of the euro, which we're moving into next, remember these are weekly charts. It's telling a lot more of a tell of how we're going to cross quickly into these areas. Now, in all fairness, we're getting ready to move to Florida. Haven't had a lot of time. We've been just buried with state agency registrations and all kinds of stuff you guys don't even want to hear. It's been a fog to climb through at 100 miles an hour. So I don't even know how any of our softwares have done through this period, right? I don't know. I have no clue. So I'm not trading any Forex the last couple of weeks. I'm just too busy to have things, on big chunks of live money when I can't monitor it. So I don't know. I'd be curious to see how everything did through the last 2 weeks, because this chart, and, it's not complete uncorrelated to the DXY, but, the DXY is mostly euro and yen in terms of its movement it's based on. But, it's the exact opposite of what took place, right? Take a look at the British pound. Not quite the same story. It's holding a strong line, right? If one didn't believe in the philosophical awesomeness of Desan squeeze zones, here's a great test of that, right? Look how strong this has been holding that zone base. Poked under it for a couple of days. I don't know how many days it was last week. We could jump back to weekly, but it's now holding that. And if it continues to hold, certainly for another weak candle to print some sort of doji or indecision, it's probably a good chance it may go up a little. Or could be wrong and it completely crushed down below it. So those are the main ones I want to spend some time for you guys, is just to focus on. Always know that your best risk management is a practice of something like the following. Well, I think, and I generally feel statistically, this is going to happen, but I'm planning, or I have a backup plan if that happens, right? So cause and effect, essentially, in its rawest form. All right, so let's go back to the daily. Reset our scale. So US dollar CAD, long base we've been in. Jump back to, we've had to look at a lot of weeklies recently because we're out of the balance areas in much stuff, but not this one. Still mired in a sideways trade. USD JPY, okay, we've lifted up. Slight pullback. This argues for a lift higher. Right, no surprise, dollar's lifting. USD CHF coming back up against this. Again, no surprise, dollars rallying, maybe pushing out of a lot of bases that have been built over long periods of time for much of these majors that we're looking at. AUD, again, no surprise, weakness in another major strength in the dollar. CAD CHF still stuck in the mix. CAD JPY, GBP CAD. Okay. Now notice we broke down from the daily, couldn't get back up above that. I think the natural resource company, natural resource countries' underlying currency have seen strength just because of many factors, but certainly in Canada's case, the value of the vast majority of the national resources that are pulled out of this country, including gold, has gone up in price. So it would lead you to believe the Canadian dollar would be stronger against a lot of the majors. This is playing out to that very force, to the point where we actually could see the pound probably go underneath this, unless we see a big old reversal in energy prices. So you can always jump back after a look at something like that, or an Aussie view, a very natural resource rich country, and then go back to what's going on in oil, right? You can look at all of the types of oil, nat gas, heating oil. I'll look at the futures markets for a lot of that stuff, but just taking a look at the main currencies, I'm going to jump back to what's going on in the oil markets here. So we've been stuck in this 81-ish, or more like the 80-ish to 84 range, and keep in mind this is WTI. You can look at them both. Many of these trade in either a contango type of situation to Brent. Notice the VIX is low, as I'd mentioned. Equities are rallying no surprise. Gold now, on the other hand, almost the same thing happened to gold that happened to the dollar. Can't say it's the same amount of time spent basing, but it's close. And then it came back up against that area, and there's no way I'd be stepping in front of this. So a lot of the gold shorts are running. I think the surprise now, if any, I'm always looking for surprises, right? We may start to build a base or even make a run for 1900 and trade between these two areas. The surprise would be if this 1830-ish area an ounce was not to hold on a pullback. That would be the surprise. What else? Anyway, GBP and ZD. Do note what's going on here. Had a pretty big move. I think this is probably more strength of the pound versus weakness in NZD. Here's the battle done under here. Still long base we've been in. Just can't seem to get back up into other than just a 1 week spent, or 2 weeks actually spent above that area. What else? I don't show the FT100. It's like an S&P 100. DAX, notice new highs. Do note this if you're trading indices. Just remember, if you're trading something that's S&P or Dow or NASDAQ based in MT4 land, you always want to pay attention to what's going on into the 4 broad indexes, right? So DAX, UK, certainly. There's versions of this, Stock 600, there's, the Dow, but I pay attention to all. If one's breaking out and you're against that grain short, it's some sort of longer time frame, or I should say shorter time frame, like an hourly chart or 240, do note that those tides can lift all boats and barbecue your shorts, and the exact opposite if you're long at some lower level. We just want to be looking from a risk management standpoint at other indices that could be pulling. Now, I don't really think, just generally in this case, there has been times when the DAX absolutely led U.S. markets around, but that's not the case right now. So it is currently the puppy to the German Shepherd at this point, but that can always change. Let's see if I'm missing something here in setups. This I thought was interesting. This is a 4-hour chart, so more for like the swing trading on smaller time frames type stuff, and you see the breakdown that took place. Obviously, I talked about, but in maybe not necessarily 4-hour unless you're trading 4-hour charts a lot, but certainly if this was to take place on a daily chart, this can act as a Bollinger Band or a 2 sigma or some sort of just an extension of a movement. So we've had such a move down into an area, what I like to call the golden number, which is anywhere between 127 on the fib scale to 168. A lot of times can be an exhaustion point for an extension, or what I like to call some sort of extreme rip into that, right? So you can also look to see, well, would that on a 4-hour chart coincide with a Bollinger Band move? So not quite. So here's a 4-hour chart of the same chart. They're just lining fibs on it, just looking at, picking a couple of points for your fib, the Fibonacci's, and then instead of worrying about retracements, you're worrying about what's called extensions, right? So can just be another arrow in your quiver as far as different points in technical analysis and confluence levels that you're looking for in the aggregate. It's more risk management tools is what that piece shows. All right, so if you guys don't have any questions on anything, I think I've covered hopefully to everybody's satisfaction, the macro environment. Look at crypto. So you've had a lot, if you're sort of new to looking at this chart, best to look at it from a weekly just to get some context if you're new to what's going on in crypto land, or if you suddenly woke up from a coma over the last 5 years. The real takeoff was about a year ago at this time. We'd been basing, probably hard to see some of this down here, but got as low as about the 4 to 5 area on this coin, and the thing just absolutely took off, had a big pullback, and now we're sort of breaking out to new highs because it's sort of gaining some love on the global spectrum among institutions. They've had some ETFs come out to trade mostly the futures markets, which do not hold the actual coinage itself, right? But looking at the chart from a daily perspective, we have support here. There has been some more negativity. So, I think technical analysis certainly can play a very vital role in analyzing this, but man, it is just playing second fiddle to rumors and news. It really has. And when something really is on the back burner, it's difficult to put large chunks into this. I'll tell you guys a funny story. So we're moving to Florida. It's a pain in the ass. Everybody's moving to Florida or Texas, and there's movers, and you can't find a damn moving van company. And I made probably 10 calls and gone through all kinds of stupid analysis of all the furniture we have in our house. It's crazy. So anyway, I get on the phone with this guy the other day, and he's like, well, oh yeah, he's like, you're a financial advisor here. He's like, yeah. He's like, I got a whole bunch of crypto. And you know how these stories go, right? All this crap was the same in 1997 and 2000, 2008, right? All the bubble type periods, you have like the front covers of magazine talking about stuff, and every Tom, Dick, and Harry, there's nothing but risk management in this stuff. So this guy's got like 45 G's. We're actually going to go with this moving company too, but the guy's got like 45 G's. It's every dime he has, and nobody's ever had a risk management discussion with this guy. So I basically said, look, I'm going to give you a piece of advice. Okay. Unless you can truly afford to lose this 45 grand, essentially for it to go poof, take some off the table, right? Especially while taxes are low, especially if you've held it for more than 12 months, which he has. It's actually pretty decent. So maybe this guy's got that diamond hands, whatever they call that shit these people have. But the hold on for dear life thing, it's not a risk management strategy. It's stupidity. So what I explained to him in the course of a couple of minutes that I've talked to you guys ad nauseum about is do not have all your money in one asset unless you truly can afford it. Or if you're stupid enough to say the following, well, I don't really care if it all goes away. I'm shooting for 400 grand. I want to go 10x from my current level position, right? Somebody that says that, or somebody that thinks that, just as my old billionaire boss used to say, you can't fix stupid, so don't waste your time on it, right? But I did say this guy would take some off the table. Call me anytime if you got any questions. Just make sure you get our furniture there safe and unstolen, which is not really an issue, I guess, with these guys, but, I don't trust anybody. So the moral of the story, again, as we use a different story to present that, is that it's really friggin' important that you don't put all your money in one asset, right? Now, some people say, well, I have all my money in a house. That's fine, right? The individuals on the radio like Rick Edelman or a Dave Ramsey or Susie Orman and all our jackets, these individuals preach a lot of paying off debts, and that's fine. I do understand that, but in the last 12 years, as long as you don't have a ridiculous amounts of debt, you have done far better than the 3% that you're paying on a mortgage. Hell, just make up let's say your mortgage rate's 4%, right? It's ridiculously high in the current climate. Let's just say it's 4%, right? So your opportunity to make money far, far greater than 4% rate on your money. Why would you pay your house off? This is in stark contrast And most of the followers of these types of radio personalities will say, well, I don't want to be in debt. Hey, that's fine. But you just had a golden opportunity over the last 12 years to turn the same 300 grand you used to pay your house off into $1 million. Your opportunity cost loss from a risk management standpoint is the 700 grand you just left on the table. And when you present it to people that way, they're usually just like, well, I don't have that kind of luck. And what they don't realize is they worked really hard to pay the house off. If they had taken maybe a 16th of that time working and learned how to invest, they could have that 700 grand. Most people don't get that. I think most of our subscribers do. And the cool thing about a lot of you guys, especially been listening to all of us harp on all these issues over the last year, is that you're of a different cut of the cloth. And for that, I applaud you. But do yourself a favor and just understand opportunity, cost, losses. There's both sides of the equation. That, my folks, is the presentation for the day. So I wish everybody well. Do keep in mind, with all the craziness going on globally, compliance is the nutrient by which tyranny thrives. Don't fall prey. May the trades be with you guys. Be good.